Thank you, Phil Flynn. Markets geared up for another big day of gains. Joining us right now is American Century Investment CEO and President Jonathan Thomas. Jonathan, good to have you. Thanks so much for joining us.
Good morning, Maria. Great to be here.
So your firm with $140 billion under management, what do you do in a market that is as volatile as this? What are you telling clients these days?
Well, the volatility definitely has people focused on the market and what's going on. Of course, on any given day, the markets move as much by emotion as it is by underlying fundamental factors. But over a long term, fundamentals definitely drive it. We're seeing a lot of clients right now looking for low volatility products. They're looking for stuff that absolute return sort of products, non-correlated sort of instruments that they can invest in.
Yeah. So was that it, Anthony Scaramucci? Was that it? We had a 1,000-point sell-off two Mondays ago, and sort of very choppiness, and now 2 days of gains. Well, are we done with the correction?
I really want to talk to Keith about this because
yeah, so I
actually think a lot of this stuff is Fed related. I think that the data suggested that the Fed was probably going to raise rates. Markets started correcting. Then you had the debacle in China. Market further corrected. Now I think you're seeing that China is really not going to impact the U.S. economy as much as the original fear. And now there's a question of whether or not the Fed is going to raise rates. My guess is that they probably won't. I don't know what you think.
He's been saying it for a year and a half.
But the main problem here is, and to Thomas's point, is what they should do versus what they could do is the biggest risk. You can't actually tell. Look at 2-year bond yields this morning. They're back, for the 6th time in 6 months. 2-year yields, the short end of the curve, is testing like this same breakout point while the World Bank is begging the Fed not to do it. So again, I still think that many people at home are sitting there worried that the Fed raises rates into a slowdown. They shouldn't, but if they do at this point, Fed fund futures yesterday's collapsed. That means that the market's saying, we're betting you're not doing it. The Fed typically doesn't go against that curve. So again, it is a developing risk, what they should versus what they could do.
I think the market's reacting to that. Now, the question is whether they should or shouldn't raise rates. We can debate that if you guys want to.
Right.
The data, to me, suggests that a quarter-point raise is not going to impact the markets. Mike Collins said earlier, probably causes the market to rally.
Yeah.
We can debate it. The point is the Fed has to start normalizing at some point. It probably won't be right now.
Right.
Markets reflecting that. Markets trade higher.
Jonathan, where are you on this subject? Do you hear sort of questions from clients on the Federal Reserve meeting next week?
We do. I mean, what the Fed funds forwards imply actually is that there's only a 28% chance that they'll be raised in September, 40% in October, and only 59% in December, in fact. That being said, if you take a longer view on the whole thing, I don't think, 3-4 years from now it's going to actually matter all that much whether we raise rates in September, October, or November. I think what really matters is after that first move, how fast are they going to go up from there? In all of this conversation around raising rates, there's an implication that once they start, they're just going to keep moving, and I don't think that's necessarily true.
Right, maybe
a signal to the market.
I want to, Jonathan. Be specific. Yeah. What are your investors doing with their money? Talk about outflows out of equity funds if that's happening, inflows into fixed income. Even within fixed income, where is that money going? Does the money look stable or does it look shaky?
For our firm, we're actually in positive net inflows this year, and you're really seeing 2 types of products gathering a lot of assets. One are what are known in the industry as target date funds. These are the sort of funds that are for long-term investors that you put your money in, that professionally managed with a glide path to manage risk over longer periods of time, and your risk profile changes as you approach your target date. And then the other sort of product we see is actually a lot of alternative products. We have a product called American Century Alternatives Market Neutral Value, and it's a sort of product that uses a pairing strategy to really reduce volatility. You're going to get, a risk-free rate plus 300 to 400 basis points.
Did it
and
reduce
clients
volatility?
In these periods of volatility are looking for that.
Did it reduce volatility in August?
I'm sorry. One more time.
Did it reduce volatility in August?
Oh, absolutely. In fact, year to date, the fund's up like 4.5%, and through the pairing strategy, it's a relative value arbitrage strategy. And yes, each and every day, it actually provides positive absolute returns.
Now, how do you get? Let's argue, for argument's sake, because every global macro indicator is indicating it, that the tail wagging the dog here isn't actually rate hikes; it's that the world's growth curve is slowing. How do you start to walk your clients down that path instead of this perpetual fear of a rate rate hike into the slowdown, are you talking to people about how growth could be a lot slower, sub 1% type GDP in the U.S., sub 2% globally? Is that the fear yet?
Yeah, I think there is a global concern out there. Obviously, China weighs heavily on everybody's mind. But we kind of see a 2 to 3% growth rate. And actually, if you're going to pick one of the tails to focus on, I think the tail of a large break to the upside is probably more likely than a break to the downside at this point.
Nice.
China, I was just over there. China's fascinating. We talk a lot about their economy and their market, but the people in China are actually talking about the government. Can the government keep it going? And the collapse that you saw in the Chinese market recently had more to do with people's confidence in the government's ability to control the market than it did about the market itself. Yeah. And recently, with their all their talk about forceful stimulus, that confidence is rebuilding, and that's buoying all of the markets around the world right now.
JT, good to have you on the show today. Thanks so much.
Thanks, Maria.
See you soon. Jonathan Thomas there, American Century, joining us. By the way, I think